Now, can you what you explain in regards to long-term care? It's not just the nursing homes. It could be assisted living, or even the ability to have a care provided in your house.
Yes.
So, what would you say are some of the risks of not planning for this risk?
Yeah. So, not planning for the risk can be financially devastating. It can tear families apart. For so many people that are married, for example, especially us men, we're the worst because we think my wife's going to take care of me. Well, it doesn't always work that way. Think about today. So you can tell I got a little bit of a round face. I'm a big boy. Okay. I don't know if today, if my wife, I'll be 59 next week. My wife's 57. I don't know if something happened to me tomorrow. I don't know that my wife could lift me in and out of bed, in and out of a chair, help me get dressed, help me take a shower. And that's today, and we're young and we're healthy. Think about when we're 80 years old, which is when most people need long-term care, is right around age 80. Think about my wife at age 80. How's she going to move me then if she can't do it today? She's not going to get stronger as she gets older. I'm sorry, it just doesn't work that way, right? So that's one thing to think about. Spouses will do everything they can for you, but there's limitations. The family in general can be it's very difficult. When my two sisters, when my father needed care after my mother passed away, we jumped into action to help take care of my dad. And he didn't need a lot of care, but he needed to be watched over, made sure he took his medicines a couple times a day and meals and those types of things. And so my sisters and I were ready to jump in. I was still working full time. I travel for a living, so I'm gone a lot. So I wasn't the most reliable person, which meant it was my two sisters that also lived a lot closer and were retired, had to take care of more of the things than my father. And generally, it's one of the children that jumps in and either provides the care
Hmm.
or pays for the care. And then what happens is it tears the families apart because that one sibling that provides all the care or pays for all the care later on says, why did I have to do it? I love my mom or I love my dad, but why was I the one that had to do everything? And as I like to tell people, it tears families apart. And by having a long-term care plan in place, and a long-term care plan doesn't always mean insurance. And we can talk about that, and I'd love to talk about that a little bit about a plan in general. But having a long-term care plan in place means that it won't tear the families apart, and that unfortunately at that loved one's funeral, you and your siblings will still be speaking to one another because one person didn't take on the entire burden, whether it was financially or emotionally and physically. So it tears families apart if you're not planning correctly. It can wipe out, as I said, life savings. People have been forced to sell family farms, the home. It's just not what we've worked our whole life for, to have the last, in some cases, few months to few years, everything lost by not planning for a long-term care event. And so it's important to plan ahead for long-term care.
Ken, you mentioned having a plan in place and it not being solely on insurance. Can you expand on that? What does that mean?
Yeah, sure. So thanks for that, Cameron. So when I look at long-term care planning, there's a few things that we need to look at. So the first one is, some people say I'm gonna pay for this out of my own pocket. I've put enough money aside, and that's going to be my long-term care plan. And that might be the case for some people. They do have the financial means to do so. I would argue that maybe they still want to have some coverage. And I'll come back to that in just a moment. But even if you do decide you're going to pay for this out of your own pocket, you still need to have a plan. You need to have a written plan, because let's just say I've got some money at two different financial institutions. Normally I use them, but I probably shouldn't name a financial institution. So I've got money in two different banks.
Mhm.
I've got some stocks and I've got some bonds and I've got different investments. And at Bank A, I love the tellers, and at Bank B, the tellers aren't as nice. Well, so when I need care and I have to pay, and I'm incapacitated, so my kids step in and they're going to manage my financial affairs, and they don't know that I don't really care for the tellers at Bank B. But my wishes would be, let's drain Bank B first, because I really don't care about that bank like I do Bank A. Maybe I bought a stock and it has I have an emotional connection to it, and I want that stock to be sold versus this other stock that, hey, I just bought it because it looked like a great opportunity. So just having a written plan of how to divest our finances is important, to make sure we do it the way that I'd want my money to be spent on my long-term care. And then when we have money that we can spend on long-term care, and I'll use my own self, my wife and I, when we bought, and we actually have a few long-term care policies, makes
Mhm.
sense, right? Since I'm in the business. But when and if we ever need long-term care, the policies that I've put in place will not pay 100% of the cost of our long-term care. And I did that knowing that that would be the case. What I wanted to do is I wanted to take enough of the risk out of my pocketbook and put it on the insurance company. I still, when I retire, as many people, when they retire, they've got X amount of dollars that they have for their core expenses.
Mhm.
But if you've done well and you've planned well, hopefully you've got some discretionary income that's to go out to eat and to go to the theater, to go to ball games, to travel, to go to the movie, whatever it is that you like to do that is beyond your everyday living expenses. So you've got this discretionary income. Well, I know we're going to have enough discretionary income that, at least I believe we will, that we'll be able to make up the difference between what our long-term care policy will provide and what the cost of the care will be. Additionally, additionally, some of those things that my wife and I like to do today that we'll do in our retirement, if something happens to one of us, some of those things are going to stop. If we like to travel and I'm incapacitated, or I just, for whatever reason can't travel anymore, my wife's not going to go without me. Well, she may, but I hope that she wouldn't, that she'd stay home with me. So all of a sudden, those dollars that we were using to pay for travel, we could use to pay for some of the cost of long-term care. So I can bring my premium down of what I actually need to buy in the way of long-term care coverage. And that's a decision that everyone's going to look at a little differently, how much they can fund out of their own pocket versus how
Mhm.
much they want of that risk to hand over to the insurance company to pay for it. And in fact, some people say, if I'm going to buy long-term care coverage of any type, I want it to pay either 100% of the cost, or I don't want it to pay anything at all. I'm not buying it. And that's fine too. Everyone's got a little different risk tolerance, and that's what we have to build the plan to meet that risk tolerance for every individual. And that's the beauty of the long-term care policies on the marketplace today, is there's a lot of flexibility to mix and match and make them work for you personally.
Ken, on that note, what are some of the solutions available to pacify this long-term care risk?
Yeah, so today there's really two different types of long-term care coverage. There's what we refer to, and I referred to it earlier, as traditional long-term care, and that's the world that I started in back when it was nursing home coverage and then ultimately long-term care. And what that means is a long-term care policy. It's meant to do one thing and only one thing. If you need long-term care, whether it's at home, in an assisted living facility, or in a nursing home, it pays either a daily or a monthly benefit for every day that you need that care, either at home or in a facility. There's some negatives with the traditional long-term care insurance. One of them we already talked about a little bit, Anthony, and that was the rate increases. So those policies have seen rate increases and are can have rate increases, so they're not guaranteed, so they can have a rate increase. The other is they're a little more difficult to qualify for. They are an underwritten product. So we will, as an industry, we look at your medical records and your kind of your health. What medicines are you taking, and what medical conditions do you have? And then we make a determination whether or not we can actually insure you for long-term care. So that's another consideration. And then the third one is that it's and this is going to sound a little harsh, but it's a use it or lose it. And the best way to kind of give an analogy to that is think about your car insurance. You pay $1,500 a year for your car insurance year after year after year. And the good news is you never got in a car accident. And the bad news is you just spent potentially tens of thousands of dollars on car insurance and never got anything back. But what you did have, and what you did get out of that policy, is you got peace of mind, right? Not only is it required in most states to have some coverage, but most people, if unless they're driving a not a very desirable car, they have more than just the basic required by law coverage, because they have a nice car, they want to keep it protected in case something happens to it. But if you never use that car insurance, it's gone forever. And the same thing holds true with long-term care insurance. Now, the type of product and the company that I work for, our product works a little differently. It's what is referred to as asset-based long-term care. It's also referred to as a hybrid long-term care policy. So it's a long-term care policy that pays for long-term care just like a traditional long-term care policy pays for. But the difference is as we like to say, it's built on a life insurance chassis. And what that means is that if you never use it for long-term care, there's a death benefit for your beneficiaries if you never use the policy. So all this premium dollars you're spending over the years, it's not gone forever if you never use it for long-term care, because not everyone will file a long-term care claim. So for those folks that never have a long-term care claim, they're protected for their entire life. And if they just one day pass away in their sleep, which is what we all hope for, right? Is to just one day just go away in our sleep. It doesn't happen that way always, but if we do, now you've got a life insurance, a death benefit that is a tax-free death benefit that's left to your beneficiaries, whether it's your children, your grandchildren, a charity, whoever that may be. So you weren't just spending this money and never receiving anything. And yes, you didn't receive anything because you passed away, but your family did, or whomever you left that death benefit to.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.